Japan's bond yields are spiking, their yen is falling in value, and their government has just announced the largest single stimulus package since the COVID lockdowns, right as rising inflation is the single largest issue facing the Japanese economy. Now, none of that, I'm afraid, is hyperbolic, so it makes sense why every single investor and institution in the world right now is watching Japan like a hawk, hedging against a crisis and trying to work out what is going to happen next. But the scary thing here is how you and I, and actually everyone outside of Japan, is going to be impacted by this chaos in Japan. So in this video, I'm going to break down and explain everything, why the markets are so worried and what is likely to happen next. So let's now start off with just a very quick little bit of backstory about Japan, because they've been a really weird economy for decades now. They saw this massive economic growth and boom in the late 20th century. They saw literally the most expensive property market in the world, this monstrous asset bubble which was propped up by the idea that Japan was getting wealthier and very soon it would become the richest country in the world, far wealthier even than the United States. But then the bubble popped, the economy, it saw a massive recession, and Japan never really recovered properly. This here is a graph of the Nikkei 225, sort of Japan's equivalent to the S&P 500, and this is the record it set in 1989, and it only beat that record in 2024. So, 35 years to break its highs for the equivalent of the S&P 500. That's pretty representative of how slow Japan's economy was growing over those following 35 years after that bubble popped. Now, alongside that very, very low GDP growth and very slow-moving economy was very, very low inflation, which led to this really weird economic model which was pushed by the Japanese government. It started off in 2012. It's been coined Abenomics, named after the Prime Minister back then, Abe. Now, it was essentially huge government stimulus, right? There was massive money printing efforts and there was 0% interest rates, even going into negative interest rates as well, all to try and get money moving around the Japanese economy, right? To get people taking out loans and spending more money and investing into businesses. And it wasn't a complete failure, but it didn't really work too well either. It didn't turn into massive inflation, which a lot of people were fearful of, but it also didn't really boost their economy in any real meaningful sense either. And since COVID, Abenomics has started to become a little bit worrying. Now, the reason for that is there was, again, massive fiscal stimulus that came in during Japan's lockdowns, just like we saw in America and the United States and Europe and everywhere else. Literally, the Japanese government, they were just sending out cash and checks to Japanese households, just like in the US. They were giving out subsidies to businesses to keep paying their staff even if they weren't working. There was this insanely loose monetary policy, these negative interest rates. And finally, all this money printing as well, plus the supply side pressures that we saw from factories being shut down in China and the like, that finally caused inflation in Japan for the first time in 3 decades. So Abenomics suddenly took a little bit of a back seat and interest rates started to rise. Wages started to rise. Stimulus and that government spending, it started to reduce, and we saw a little bit of a crisis emerge in Japan, a slow, steady one. National debt was massive, more than 250% of the country's GDP, and the interest on that debt was no longer close to zero, it was now significant. About 25% of the Japanese government's budget was spent on basically just servicing the national debt, which is a ridiculous number and far worse than any other major developed economy. And that really takes us to where we are now, with a brand new right-wing Japanese Prime Minister called Takaichi. Now, she begins her tenure, as you can see here, as Prime Minister of Japan with a rare combination of political momentum and market confidence. Her public support ratings exceed her predecessors, and equities rose nearly 10% since she became the leader of her party. There's optimism that as Abe's heir, she will launch Abenomics 2.0 of aggressive monetary policy easing, flexible fiscal policy, and structural reform. So she is the spiritual, the literal follower of Abe, whom after Abenomics was coined, and she's started pushing back towards his policies, but with a couple small changes. And as a part of that Abenomics 2.0, she's just announced a massive stimulus package. The Prime Minister Takaichi's cabinet, they approved the largest round of extra spending since the pandemic, deploying funds to address the frustrations of voters in a package that may unsettle investors who are scrutinizing the nation's finances. The stimulus plan will feature $112 billion and general account spending, representing a clear jump from last year that will be reflected in an upcoming extra budget. The total package is valued at 21 trillion yen, that's around about 150 billion US dollars, with the bulk of the measures aimed at price relief. And I quote, "We've put together this package to protect livelihoods and particularly to respond quickly to the problem of inflation." So the key focus of this stimulus package is literally putting more money in people's hands, in their pockets, giving them tax cuts or giving spending increases, in some cases literally giving money away to try and tackle inflation. Now you can see some of the actual measures here, right? They're giving subsidies for households' gas and electricity bills over the next 3 months. They're giving off literal cash handouts for families with children. They're giving out funds to aid specific regions within Japan. They are cutting gasoline taxes to make it more efficient and cheaper to drive, and raising the tax-free income ceiling as well, basically reducing the amount of income taxes that people are paying as well. Now the problem is, all of these policies here are actually inherently inflationary, just like we saw with the stimulus during those COVID lockdowns and the stimulus that came afterwards, right? Everyone likes to pretend that inflation is really, really complicated, that prices rise for unknown reasons, but the truth is actually incredibly simple. Prices are always a product of supply and demand, right? We have higher demand, we have higher prices. We have lower supply, we have higher prices. And stimulus in this form, putting more money in people's pockets, they're going to spend that money. That will lead to increased demand. That will lead to higher prices or pricing pressure once again. And so these policies to protect people from inflation will have a little bit of impact over the short term, over a few months. But in the long term, they will just cause further inflation because they'll just be subsidizing demand and increasing demand, and they'll make no difference to people's actual inflation problem. The Japanese government, though, they're not stupid, right? They know this is the case, but that stimulus is designed to tame voters, to make them feel better, not to actually fix the problem. Now, as a result of all of this, the Bank of Japan is going to be left with the monumental task of actually reducing inflation in Japan by trying to hike interest rates, and that's what we've seen more recently. Bank of Japan officials are ready to raise interest rates at a policy meter later this month. I think it's December 19th, provided there are no major shocks to the economy or financial markets in the meantime. The central bank will also indicate it will continue to raise rates if its economic outlook is realized, while remaining cautious on how far they will eventually push rates up. Officials see a high likelihood of increasing the benchmark rate by a quarter percentage to 0.75 at the end of their gathering on December the 19th. That rate hike would push the policy rate in Japan to its highest level since 1995, 30 years ago. A key market focus is how aggressively the central bank will point to additional hikes after that. If we take a look at what actual investors think are happening, we can go onto Polymarket here and see what people are betting on. And we see that the chance of a Bank of Japan decision in December of a 25 basis points increase, the people actually putting their money on the line, 91% think there's going to be a 25 basis point increase, whilst only 10% think there is going to be no rate hike. So it is well and truly priced into the market at this point. And as one final little cherry on top, key Japan officials would go along with the Bank of Japan December rate hike. Essentially, key members of Prime Minister's government wouldn't try to stop the Bank of Japan if they decide to raise interest rates in December, making that all the more likely. So the Prime Minister and her cabinet, they know the rate hike is likely at this point, and they're actually okay with it because they know that that will actually serve to help tame inflation, and it's essential, especially since the government are now running inflationary monetary and fiscal policy. Now, this is being called a gamble by a lot of people, by investors and bankers and economists and people putting their money on the line, and for a fairly good reason. Abenomics didn't really work. Again, it wasn't this disaster, but it wasn't a massive success either. And the idea was actually quite simple, right? The government, they stimulate the economy with lots of spending. They set monetary policy to incredibly loose levels so that debt is cheap and investment is easy to make work. And that will encourage people to grow, just to spend their money, to invest, to boost the economy. That will make everyone richer, and that newfound wealth can easily pay off the debt that the government is taking out to run those policies. And because interest rates were so damn low, in particular during the 2010s, well, the interest that the government is paying on that debt, that's so low anyway that even a very low rate of economic growth, that's more than enough to outweigh the cost of the debt, and it's all this great big success. Now, Japan did see small amounts of economic growth over the 2010s from Abenomics, and interest on Japan's debt, that it was actually relatively low, and sometimes even better than incredibly low. It was into the negatives. Here's a graph showing the 10-year Japanese bond yield over the last decade. We see that the highs for something like 2018 were 0.1%. The lows were literally 0.2% negative. And all of that really started to change as we came out of COVID and we started seeing some real inflation in the Japanese market for the first time in 30 years. Now again, Abenomics was okay when interest rates were hovering around 0.2% at the absolute highest and then negative at the absolute lowest. Abenomics was okay because it was so cheap to service that national debt. But once inflation came in and interest rates started to rise, when bond yields started to rise, the actual cost of servicing that Japanese debt is skyrocketing, and now it's sitting 1.972% for the 10-year yield, just under 2%, a monstrous increase compared to where Japan was just a couple of years ago. And it's also worth noting that this isn't actually very closely correlated with interest rate hikes in Japan either. The interest rate at the moment is just 0.5%, up from the 0% it was at a couple of years ago. So as inflation has risen from 0 to 2%, interest rates have only been hiked from 0 to 0.5% and likely to go up to 0.75 over the next week or so. So bond yield debt is getting much more expensive than the Bank of Japan's decisions to raise interest rates. And this is much more closely correlated with inflation than with interest rates in Japan right now. Now, Japan's debt is more than $9.2 trillion right now. A 2% service cost on that is a monstrous almost $200 billion per year just on interest payments alone. That's the equivalent of 300% of Japan's military budget. And that's the underlying issue here. Abenomics now looks completely unsustainable for Japan because debt is no longer free for the Japanese government. And at the same time, the new Prime Minister is sort of starting Abenomics up again, though in their own little way with a few tweaks, and that's very worrying, seeing interest rates at the rates they're at. Now, it's incredibly likely, in my opinion, that this is going to go in a very similar direction as the global financial crisis, right? We have this huge over-leveraged financial system that's once again all based on debt. And we're all going to see either an outright open bailout like we saw in 2008, or maybe more likely, in my opinion at this point, infinite money printing like we saw with COVID, leading to massive inflation that still ends up being paid by you and me in the end anyway. I genuinely see no outcome where any Western country isn't in dire trouble after this and literally incapable of not stealing from ordinary citizens to pay off this credit and this debt financial disaster, which is why personally I'm so cautious with how I'm protecting my assets, and I'm personally focused on trying to squirrel away as much as I can whilst the sun is still shining. And I think it's so important we're able to recognize that and protect ourselves against what's coming, because it is unfortunately going to be bad. And so I want to help you prepare for these problems as well. So I've put together and I'm running a free class teaching you how to build a $3,000 a month online side hustle from scratch today. It's 100% free. I spent the last month putting this class together, spending dozens and dozens of hours on making it better from the last time we ran it. And in it, I'll show absolutely anyone how you can use this new system that my team and I have built to build an online income up to $3,000 a month guaranteed. Now, there are limited spaces available for the free class. There's only 100 spots free. And last time we ran one of these, those spaces filled out on the first day we announced it on the channel. So click that link down below in the description to save your space and to see what time that free class is actually happening on your time zone. Again, it's free. I'll show you everything you need to build an online passive income without needing any prior experience, so that you can protect yourself from a crisis like this, and we'll even have some fun on the free class as we do it as well. Now back to Japan, and why does any of this really matter? That's a question I get from people a lot when I talk about these very far away economies like Japan, right? We're not in Japan. Japan doesn't import a load of stuff from the US or from Europe, and so frankly, from most people's point of view, if Japan disappeared tomorrow, not a whole lot would change for them on the surface. But of course, this all comes back to our interconnected global financial systems, and in this case, the yen, and its value compared to other currencies. Now, the yen has been pretty weak recently, with some drastic changes in value with some big drops, which are very worrying for investors. Japan's had very low interest rates for years and years and decades, which meant that owning yen was bad, right? Because there wasn't much money you could make from owning yen. On the other hand, owning yen debt was actually really good because interest rates were so low, so it would cost you almost nothing to service that debt. And that meant that trading yen for another currency was almost always a good idea, as that forced the yen's value down and kept it weak, and that helped to make Japan's exports competitive overseas, right? Because the amount of customers in the US, right, if they pay for a Japanese car in dollars, the amount that they pay in dollars stays the same, but the amount of yen the Japanese seller gets after the value falls, well, that's going to increase, so that's good for their exports. But as Japan's monetary policy is changing, they don't have ridiculously low interest rates anymore, and so that relationship is changing a bit as well. And again, in isolation, that's not always a bad thing, but the issue is Japan is the single largest foreign investor in American debt. When the US government wants more money, almost always over the last 30 years, they create a new bond and they sell it to the market. And the buyer, about 20% of the time, has been a Japanese investor. And this led to literally trillions and trillions of dollars flooding into the American markets from Japan, with that debt now held by Japanese investors, which is essentially just additional demand for US dollar debt, which forces prices up for US dollar debt and bond yields or interest rates down. So a huge part, probably about 1/5 or 1/6 of the US's cheap debt and their zero interest rate environment, the low bond yield environment that we've seen over the past 20 years, that's been a result of Japanese investors plowing into the American market at such a huge rate. But now that relationship is starting to be threatened because yields in Japan are real now. They're not the 0.01% they used to get a couple of years ago, or even the negative amounts, right? So now Japanese investors actually have the option and the ability of buying their own government bonds, not just foreign bonds. And as this relationship breaks down further and further, the US is going to stop benefiting from the investment from Japan, and they will see yields and interest rates rise as a result. Now, this kind of impact could be genuinely monstrous to the United States. I'm talking about the additional cost of servicing the US national debt to the tune of maybe something like $200 billion per year. And it won't just be the US federal debts that's impacted as well. Japanese investors, they were active all over the rest of the world. Yes, they were heavily concentrated in the US, but also into corporate debt and different levels of government debt in different countries. Basically, the debt-based Western economy for 30 years where we've had incredibly low interest rates, it's all been propped up and given maybe a 15 to 20% discount on interest rates by Japanese investors, and that's all starting to unwind. And if it comes to a complete stop, that means mortgages will get more expensive to 15 or 20%. So will car loans, they'll get more expensive. Credit cards will get more expensive. Corporate debt will get more expensive. National debts will get more expensive. And that will happen in every major Western economy. So this is going to be a big drag on all of us. That is, if this relationship of inflation in Japan continues, which unfortunately it looks like it's going to continue. Bets on rising consumer prices in Japan are keeping a lid on bond yields when adjusted for inflation, in turn reducing their ability to support the yen. One important yardstick of market expectations for future price gains, the 10-year break-even inflation rate this week surged to the highest in record stretching back to 2004. It touched about 1.74% on Monday and remained above 1.7% since then, even after the governor of the Bank of Japan dropped a strong hint that the central bank may tighten monetary policy at its meeting later this month to curb inflation. While the governor's raising the policy rate would push up nominal bond yields, which is good for the yen, the impact diminishes if consumer prices keep rising too much, eroding the currency's purchasing power. So expectations for inflation are staying high at 1.7% over the entirety of the next decade. So we're not talking about this just being a bit of a problem for a year or two until Japan sort of solves itself and it goes back to this negative interest rate world. Now, of course, this has a massive impact on something called a yen carry trade, which is essentially where investors in Japan, they take out debt in the yen at incredibly low interest rates, and then they change that yen into, say, US dollars, and then they invest those US dollars into the American economy, like, federal debt from the US. Now, Japanese investor, they get good returns from that American investment on incredibly cheap debt from the low interest rates in Japan, and that has been a massively profitable trade for decades. But as the yen is now losing value suddenly, this yen carry trade, it doesn't really work anymore, because when the debt is due to be paid off, the Japanese investor, they have to change those dollars back into yen, and then they end up making a loss in the end. So in that same vein, just as we've seen bond yields kept very, very low in the West, we've also seen asset prices kept very high in the West thanks to Japan. In particular, the US has seen their asset prices inflated massively by the yen carry trade over the last 10 years, and that's now starting to unwind, which threatens asset prices across the entire country. Now, this is unfortunately too big a topic for today alone. I'll make another video in a few days breaking down the yen carry trade in full and showing you all the actual numbers. But for now, we just need to keep in mind that debt yields are likely to rise. Asset prices may go down as well, all because of Japan. Now, personally, I don't see an immediate fix or solution here. Some people are likening what's happening here in Japan to what happened a couple of years ago with Liz Truss and the mini budget here in the UK. Basically, we had a brand new prime minister come in. She announced a load of tax cuts and didn't announce any comparative cuts to government spending that would have led to more government borrowing, right? So increased borrowing costs, and the markets all panicked a little bit. In reality, it was a lot more complex than that. There was a lot more going on behind the scenes. The Bank of England were actively working against the government. They were hiding their actions from the Prime Minister. And then there was this sort of coup from the financial markets and the established elite of the Conservative Party who whipped up market angst to get rid of Liz Truss and then replaced her with their puppet Rishi Sunak. So there was a lot more going on than that. But in essence, there is a lot of similarities with what's happened in the UK back then and what's happening now in Japan. Investors are worried it doesn't really seem possible for Japan to pay off their debt or to grow their economy at this point, and now the government's spending more money and taking out more debt, and everything just looks a little bit unsustainable. And the demand for Japanese bonds is falling a little bit, which is causing yields to slowly but steadily rise. The yield on Japan's 2-year government debt has climbed above 1% in recent days to its highest level since 2008, as investors bet that Bank of Japan officials led by the governor will resume hiking benchmark borrowing costs in December 19th. But after years of persistent easy monetary policy, the rate still remains far below Group of 10 peers, even as inflation expectations in Japan are near their strongest mark in records going back to 2004. The market underestimates how high the neutral rate will need to be in Japan to relieve inflation pressures. So being underweight government bonds in Japan is the right one. And this is coming from Roger Hallam, global head of rates at Vanguard, which manages $11 trillion in assets. And he said, we still think that the Bank of Japan will continue to normalize and that it will hike in December. So Vanguard, the second largest financial institution in the world, which controls $11 trillion in assets, is literally saying that a 25 basis point rate hike isn't going to fix this problem in Japan, that the neutral rate of interest rates, where interest rates are no longer a driving factor in causing inflation, but are neutral, not causing inflation or disinflation or deflation, well, that's going to be far, far higher than the 0.75% we're likely to see at the end of this month. Now, what are higher interest rates going to lead to in Japan? Well, of course, higher bond yields even further, and a Japanese government spending even more on debt interest. They're already paying about 25% of their entire government budget on debt. That's already unsustainable, and it's only going to get worse from here on out. Now, if you want some more help or some resources when it comes to your finances, take a look at my free online masterclass here, where I break down and show you how to build an online income without any prior experience. The link to register for that is down below in the description, but there's only 100 limited spaces available, so make sure to register as soon as possible to save your space. If you want to tell me how right or wrong I am about this, or to make a video about something in particular, tell me in the comments down below. I try and read every comment every day, and if you don't want to miss out on my future videos, make sure to subscribe to the channel as well. But if you really want to help my channel out, help me grow and show more people what's going on and educate people, send this video to someone else. Click the share button, send this video to a friend, a coworker, or a family member, and help them learn about what's going on in Japan as well. The UK is screwed, and it's a shame that I'm able to say that so succinctly and with so much confidence, but that's only because it's so damn obvious. Our economy is genuinely disastrous, and over the last few weeks, the clown circus has well and truly been exposed, and unfortunately, our fate is now sealed. The Labour government have spent the last few weeks